Just put the gold price a couple $100 above the West and the silver price a couple bucks above the West. The arbitrage opportunity will send all of the metal over there. They'll get paid back. They'll make tons of money. And the East will have all of the gold and silver, and it will never, ever, ever come back. I don't know how big it really ultimately plays out to, but it's very unusual and it's a big deal. And if it continues and it persists, that sucking sound you hear will be the gold and silver fleeing from the LBMA and the COMEX and moving eastward into the very strong hands of the Chinese and the rest of the folks in the East.
The East has been driving up the gold price predominantly in late 2022 and the first months of 2023, breaking the West's long-standing pricing power. Until recently, Western institutional money was driving the price of gold in wholesale markets such as London, mainly based on real interest rates. Gold was bought when real rates fell and vice versa. However, from late 2022 until June 2023, gold was up 17%, while real rates were more or less flat, and Western institutions were net sellers. Most likely, Eastern central banks and Turkish and Chinese private demand lifted the price of gold. Andy Schectman believes that an unusual and significant situation is unfolding in the gold and silver markets. He suggests that if the gold price is intentionally maintained a few $100s above Western prices, and the silver price a few bucks above Western prices, it creates an arbitrage opportunity. This situation could lead to a massive flow of gold and silver from Western markets, such as the LBMA and COMEX, to Eastern markets. In addition to the price differences, Schectman points out significant movements of gold out of institutions like J.P. Morgan. Over time, substantial amounts of gold have left their vaults, suggesting a trend of capital flowing away from Western exchanges. This movement aligns with a historic divergence between gold prices in China and the United States, with China's prices surpassing those in the West. One of the factors contributing to this shift is how Western markets, particularly the COMEX, operate. He contends that certain practices like naked shorting can distort the genuine supply and demand dynamics for gold and silver, artificially suppressing their prices in the West compared to the East. We will now bring you clips from Andy Schectman's interview with Liberty and Finance. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
At the same time, we've seen 160,000 ounces of gold depart J.P. Morgan's vault in one day. We've seen 500,000 ounces of gold leave over the last 6 days and 1.17 million ounces, or 5.3% over the last month. Big money continues to drain the exchanges. And as that's happening, we've seen a historic divergence between the gold price in China and in the United States. At one point, it was over $110 an ounce, where it was $2,020 in China and $1,909 here in the United States. And, you know, there's all sorts of reasons that pundits are talking about. Look, for me, the key reason is that the COMEX naked shorting system distorts the supply and demand fundamentals, and it plunders resources, not just gold and silver. All of the commodities that the East are hoarding are being distorted by the price mechanisms of the West. And, you know, I talked about this several months ago, with it being maybe emanating from the new Moscow exchange. And I said, look, if they want to really drain the West of all of their gold and silver and possess it all, just create an arbitrage environment where you list the price of gold and silver much higher over there than it is over here. And you will find the commercial banks will pillage and plunder whatever available bars are available to be sold across the continent, across the oceans to Russia or to China, well, in this case to China. And that arbitrage is something that will suck all of the metal out of the Western exchanges and move them eastward, and it'll never come back. Now, I don't know if this is just market fundamentals, and you'll see it start to and related to currency controls and import controls that some people talk about. Look, as far as I'm concerned, it's the smartest way to drain the West of all of their metal. They have enough money to do it. The Chinese do. Just put the gold price a couple $100 above the West and the silver price a couple bucks above the West. The arbitrage opportunity will send all of the metal over there. They'll get paid back. They'll make tons of money. And the East will have all of the gold and silver, and it will never, ever, ever come back. Now, is this just a blip? Is this just a problem? Maybe it is. Maybe it's something that will be rectified. But maybe it's not. Maybe they open their eyes and they say, hey, here's how we do it. Here's how we get all the metal. We'll just arbitrage it. Make the price too attractive for the big traders to not sell it to us, and we'll stand for delivery and we'll suck it all up. And it ain't ever coming back then.
Analysts expect the U.S. Federal Reserve to pause interest rate hikes on Wednesday as the central bank looks to tame inflation while avoiding a recession, despite a recent energy-fueled rise in consumer prices. After 11 interest rate hikes since March last year, inflation has fallen sharply. Still, it remains stuck stubbornly above the Fed's long-run target of 2% per year, keeping pressure on officials to consider further policy action. One significant concern highlighted by Schectman is the U.S.'s inability to influence oil prices downward. This inability will contribute to further inflationary pressures. U.S. oil prices climbed above $90 a barrel on Thursday for the first time in 10 months, threatening to push gasoline prices even higher and heat inflation across the economy. Schectman asserts that the United States can no longer control oil prices, irrespective of assurances from the White House. The consequence of escalating oil prices is a heightened inflation rate, accompanied by rising interest rates and increased bond yields, which collectively pose a risk to an already inflated bond market, stock market, and real estate market. Schectman suggests that people may not fully grasp the potential ramifications of these developments. He predicts that we could witness considerably higher oil prices, potentially resulting in BRICS nations resorting to gold for oil purchases. Let's move towards the interview.
You can see the erosion of the value, the purchasing power of the dollar. It's an insidious thing, inflation, where the Fed tells us we are striving for a 2% inflation target, even though we're a long ways away from that. I've always thought that was silly. Why not strive for negative 2%? Because the lower the level of inflation, the higher the standard of living. And this is something that is very moronic to me. I mean, like I've said before, can you imagine a CEO of a corporation like Elon Musk standing on a stage rallying, saying, you know, the goal of our company this year is to lose 2%. And it's weird. But when we look at what's happening right now, inflation is a hot topic. People on one end, you got the talking heads saying, well, you know, the Fed's got inflation in control. In fact, they're probably not even going to raise rates anymore. In the next meeting that's coming up, they'll pause, blah, blah, blah. Inflation is not going anywhere. The bottom line is the U.S. is no longer in position to manipulate oil prices lower. So inflation is going to continue to drive higher. No matter what lies are being told to you by the Biden White House. And what makes it even a little more troublesome, people don't really put all of this together, and I don't think the markets have figured it out, is that as oil supply tightens, oil prices rise, inflation rises, and rates rise, and bond yields rise, and interest rates rise. This is all a perfect storm for an overinflated bond market, stock market, and real estate market. And this is the vicious cycle that feeds upon itself. And I don't think that people really quite grasp this yet. But if I had to guess, we see much higher oil prices. And you know, imagine what happens when oil hits, you know, $200 a barrel or $300 a barrel. Maybe this is just the opening salvo. And then the gold will be used to purchase oil for all the BRICS nations. And where's all the gold going? And we'll talk about that, I'm sure, with the discrepancy in the premiums on the Shanghai Exchange versus the COMEX. But the point of it is, whether you're talking about energy or the fact that we have, 130 trillion in unfunded liabilities off balance sheet that have to be paid somehow to the American public, how does that happen? Through inflation, through printing, because who's buying our bonds? China and Japan and Saudi Arabia have been selling them. In fact, Saudi Arabia right now, not only are they producing the lowest amount of oil and sending to the West in 6 years, they're at the lowest level of treasury holdings in the last 6 years. So they're selling treasuries. They're not producing as much oil. And the countries that have aligned with the BRICS, the new ones, Iran and the UAE and Saudi Arabia on top of Russia, you're talking the major oil producers in the world. They're not inclined to ramp up production. So you have a declining production. You have a mothballed oil production here in the United States, a closing of the XL pipeline, canceling of permits. I mean, you couldn't draw it up any better. And we keep going back to the same thing of What does Jared Bernstein want to do, the chief economic advisor to this country? He wants to shed the world reserve status of the U.S. dollar as an extraordinary, exorbitant privilege we can no longer afford. Well, how do you do that? Weaponize the dollar, tell Saudi Arabia we are going green so that they unite with everyone else. They have no intentions or aspirations of making life easy on the U.S. any longer, at least as it pertains to the cost of oil. And so this is something that will continue to move higher. And as it does move higher, the cost of everything we touch will go higher. Therefore, inflation goes higher. Therefore, interest rates go higher, putting more strain on the banks. And I mean, you see how this thing just keeps spiraling out of control. And I think this is something people need to keep a close eye on. And we see it moving up again today. It was up over $1. So yeah, this is a big deal and one that certainly has my attention.
Looking ahead, if the East successfully drives up the price of gold and diminishes the West's influence over its pricing, we may witness a shift where gold becomes less reliant on the U.S. dollar and assumes a more prominent role in the international monetary system. What do you think about the shifting pricing power from the West to the East and the potential arbitrage opportunities that may arise? Share your thoughts in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.